This is a perfect example of where financial advisors, professional financial advisors, completely fail to understand the buy, borrow, die strategy. And this guy calls in to the radio show and talks about he has a 400k debt and what he should do with it. Now, if you phone in the Dave Ramsey show and say you've got debt, it's like asking a dog if it's hungry. You're going to get the same answer every time. Debt is bad, debt is evil, pay it off. We know the story. So obviously he's going to get the answer. But the guy phones in, he doesn't really have a clue what's going on. He just sounded like he didn't really understand his finances. He didn't understand his strategy. And this is a guy who inherited $1.4 million in stock. So his actual father or his grandfather completed the buy, borrow, die mission. And his son or grandson has failed the strategy. Because we'll break it down. So the first mistake he makes, he phones in and says, I'm 40 years old, I'm living off my rental income, and the first thing I did with the 1.4 million is I paid off the mortgage on the primary residence. Now, we don't know how much that is, but paying off the mortgage is taking away the greatest advantage that real estate has, and that is the cheap debt. So that money is now being poured into an asset that will not appreciate as fast as other assets can appreciate. So he's destroyed his money supply expansion advantage. So that money's gone. Then he's left with 550k of stock. And what does he do? Now, on the call, he doesn't make it clear if the T-bills and the stocks are together. Now, I'm going to presume they must be together in the same broker, because if he borrowed 400k against a 550k portfolio, his loan to value would be like 72%, which is insane, right? Okay, there's no financial advisor on earth would do that. So the T-bills, I'm going to assume they were part of the same portfolio. But the problem is, now his loan to value is still high. It's like he's still borrowing like over 50%. This is huge leverage. I always say 20% is fine. And it gets worse though. What's worse is he's fell for the typical middle class trap. This is how I can tell he's not came from like an institutional affluent background, because the same trap they all fall for is they chase high yields. It's the same story. He takes the 400k and buys another rental property, and then he puts his own up for rent. So he has two rental properties, and he's paying $1,600 a month in interest at 5%. Now, the $1,600 a month in interest to most people think is like, wow, that's so expensive. But it is expensive because of what he's done. So he really needs about 5k a month, and what he's saying is his rental is about 8,000. So he's getting 105k a year. And this is the retail mindset, says, wow, 100k a year. They're chasing income rather than the wealth. So what happens? He phones up, just sell the stocks, pay off the loan. Okay, we knew that was going to be the answer. And he says, go back to work. The guy's 40 years old. You inherited $1.4 million, and now you need to go back to work. Let's look at the actual loan to value exposure. Now, I can almost guarantee with anything that he will be in a very, very diversified portfolio because he has a financial advisor. No financial advisor on earth can tell them to be more, to go into a more growth portfolio. They're not allowed to do that. It's against their job. They just have to do the same as everyone else. All world fund. So that all world fund can still crash like anything else. You know, let's look at what COVID, tariffs, that can crash 10%, 15%. So it doesn't mean he's safe just because he has an all world fund. He's at high loan to value, 54%. And he's in a deficit. He's actually in a deficit because even with his all world fund giving him 2%, his T-bill giving him 3.8%, the actual portfolio is not enough to cover his $1,600 a month payment. His annual deficit, his monthly deficit, $113. We can live with that if there was growth. There's no growth. Yeah. So what has he done with these 2 rental properties? Let's look at this, because this is where the trap is. Everyone looks at this and looks at the net margin. And this is where every retail middle class investor goes. Okay, he gets $100,000 a year, and after all expenses, it's $54,000. That looks good. In fact, he'll feel even richer because of this number here. Maintenance capex, 15% reserve to repair roof, repairs, HVAC, everything else. 95% of property investors don't put that money aside, so he feels richer on paper. He feels like he's got a higher yield per month. You know, it's over $5,000 a month, but even still, it's $4,500. However, the trap here is people look at the net margin and they don't look at the return on invested capital, which is far more important. How much is his balance sheet growing? This is the problem with everyone that chases dividend yields. Look at the options. What is his actual? Because the properties, I guess the properties, the 2 of the properties are probably worth about 1.1 million in total. So the yield on 1.1 million, he could have got that from fixed income, 4.96%. He could have got that from a bond, a 30-year treasury bond. But yet he's taking on the repairs, he's taking on tenants, friction, to get that same yield. Or he could have even done the S&P. Even the S&P, but, you know, if he was a high conviction investor, big tech, why would I invest in, why would I not just invest in the 3% or 4% of all companies on earth that actually generate a yield? Yeah, all the companies at the top are the ones that make all the money. Your all-world fund is pretty much dependent on big tech. Your S&P 500 is dependent on big tech. Your NASDAQ 100 is dependent on big tech. It's all the same companies doing it. This is where all the growth is. This is what everyone looks at. They're not looking at the other 3,000 stocks that do absolutely nothing and go sideways. So what is the alternative? What would I look at if I was looking at a family office solution? Well, first of all, we wouldn't have paid off the mortgage, kept the full 1.4 million, and I've just drafted this as an example because I don't know how much his mortgage costs. Because can his $5,000 a month pay the mortgage and his life? I don't know that. I'm just guessing because I just listened to a radio call. $1 million in the big tech or the NASDAQ. Straight away, he's not paying off the mortgage because that's getting debased away with inflation. But if we had to pay half of it off, we could still do that. You know, he still has plenty of money here. This guy's got a huge inheritance. $1 million would generate around 0.7% dividend. Then the rest in T-bill, 3.8% yield. Okay. You can get anywhere between 3.6 to 4.06 on T-bills. So what have we got? He's got 1.4 million. And then, guess what? His interest is fully covered. In fact, not only is his interest covered, he's in a surplus. Because what we've done is we've borrowed 200k. That gives him 3.3 years of living expenses. He doesn't need to deal with tenants. He doesn't need to deal with people, maintenance, nothing like that. And he doesn't need to go back to work. Because right now, he has to go back to work. His loan to value is actually safe. His financial advisor, who's a professional qualified advisor, gives him a 50% loan to value. Does the guy even know what a margin call is? So right here we have 20%. Now 20% is conservative. There is still another way he could do this. He might not withdraw all at the one time. He could withdraw it as and when he needs it. he could, live off of the 22k is coming in, and he could use a credit card for a float, then top up the difference of 3,000. He could take 3,000 out, and his loan to value would be like a single digit percentage. So let's look at the actual difference. So the difference is he's in a deficit in his current situation. His growth is negligible because he's really just relying on his probably widely diversified portfolio, his property going up in value. That's it. Whereas the growth strategy, his wealth will be worth double in 5 to 6 years. No tenants, no physical repairs, zero work required. He doesn't need to go back to work. Yeah. That's the way family offices look at it. That's how they operate. Different playing field. It's a different game altogether when you're chasing the right thing. The balance sheet goes up rather than just chasing this illusion of high income. It's the same. It's this. No matter what the investment is, if it's a high yield, you have to be suspicious. Even if it's a stock, any investment, super high yield rentals, because maybe they're in a bad area, or the tenant churn is high, or there's always a catch. When you see like a yield of like 10, 12%, you need to ask yourself, is this a bribe? Even when it comes to a stock, why are you giving me the money? Don't you have something better to do? Yeah. Never ask a genius for a dividend. And people are going to look at this and say 16%? No, this is impossible. Well, guess what I just came across? Morgan Stanley are actually more bullish than me on the data centers. If you haven't watched my video on the hyperscalers are underrated or violently undervalued, I'm going to make another one actually, because there's so much I need to touch on this, because this is what the market's all about right now. I don't care what you're invested in. I don't care what you're invested in, or even if you're not invested at all. The whole market, the whole economy is backed right now by what the hyperscalers are doing. Yeah, they're pushing the market up. And I said in my video that the ROI per, I had $5 per hour for a GPU. It doesn't need to be too technical, yeah? All this matters here is Morgan Stanley are saying a 30% return on invested capital for the hyperscalers. I said 20%. But I said it would be a lot higher for other reasons in that video. I'll add that video at the end of this. But there you go. There's growth ahead. There's a future ahead. And you have to be optimistic about the future. If you're not optimistic about the future, why are you even investing? You can just buy a T-bill or a bar of gold and leave the investing to the rest of us. I hope you enjoyed that video. Please click in the description if you haven't already. Subscribe to my Beehive where I put my spreadsheets and newsletters on. Thank you.